Namaskar, hello and welcome friends to Finavision, your one-stop solution for CFA exams. My name is Shushmita Aditya Mukherjee. I'm in the profession of finance and into AI engineering. I provide solutions for my clients and I teach students to become professionally capable. This video is part of the full class series for CFA Level 3 curriculum. Let's get started.
So friends, hello and welcome to this new chapter of CFA Level 3. The chapter's name is Equity Portfolio Management or Overview of Equity Portfolio Management. Now, the first question that we are trying to attend here is why invest in equity? What are the advantages or what are the unique advantages or what are the extra advantages of investing in equities? So one by one, let us just discuss these points. The first reason of investing in equities for majority of investors is capital gains, growth of capital, right? That is the primary reason why we invest in equities. And compared to any other assets, in fact compared to most other assets, if you have to balance capital gains with respect to liquidity, then equities comes right at the top of the list. Especially when it comes to public equities, capturing the capital gains becomes the easiest factor and it becomes the most attractive reason for most of the investors to invest in equities. The second reason is, this is the first reason, the second reason is dividend income. In fact, if one adds the dividend income along with the capital gains, the compounding rates actually multiply many-fold. Even if you look at the portfolio of stalwart investor Mr. Warren Buffett, you can observe that if you add the dividend income, the growth or the CAGR or the compounding rate grows substantially. The third factor is diversification. So when we are trying to invest, there are multiple asset options that we have. We have the option of equity. We have the option of bond, we have the option of private equity, we have the option of hedge funds, venture capitals, real assets, including real estate, commodities, timber, farm, all these things are there, right? All these range of assets are there. Now, the more diversified into uncorrelated assets the portfolio is, the lower the risk becomes, right? So, if there is an asset base or an asset portfolio which has assets which are less correlated with equities, if one adds equity into it, then the overall risk of the portfolio comes down. For example, let's say hedge funds have low correlation with the movement of equities. In this case, a portfolio which is having hedge funds, if one adds equity to it, then the risk of the entire portfolio comes down to some degree. Now that is what we mean by diversification. And adding equities in a mix of assets which are low correlated with respect to equities actually reduces the risk of the portfolio. This is the third reason. Now what is the fourth reason? The fourth reason is inflation hedge. Inflation is a year-on-year factor. It can be low, it can be moderate, it can be high. But to mitigate them, one of the very good options is to invest in equities. Unless there is a situation where there is hyperinflation, equities work out very well in terms of protecting one's investments or protecting one's capital or purchasing power from depleting due to inflation. This is one of the best ways of doing it. Now, these are the major 4 reasons why to invest in equities. Let me remove the rough work here. Now, these are the major 4 reasons why we invest in equities. Capital gains, dividend income, low correlation, inflation hedge. Now, factors that wealth managers consider while including equity in the portfolio. So wealth managers are basically those experts who are trying to create portfolios for their clients. The client can be a corporate client, it can be individual client, it can be bigger clients, sovereign clients. Depending on the category of the client, the positioning of the client, the portfolio's composition, their liquidity requirements, their capital growth requirements, their objectives, their risk appetites, their return objectives, all these things, the time horizon, all these things taken into account, they create the portfolios. Now, what are these factors that a portfolio manager or a wealth manager takes into account while building a portfolio which includes equities? So the number one reason is the risk objective. How is it measured? What is the risk appetite? All these factors. The next is return objective. How is it going to be measured? Is there going to be a benchmark or is it going to be absolute return measurements? Is it going to be active return measurement? Is it going to be how much the tracking error is? All these factors are taken into account. Then liquidity needs. What are the liquidity needs of the client whose portfolio is being managed here or created here? Is it a sovereign client? Is it an institutional client? Is it an individual client? Is it a high net worth client? Is it a client who has just entered into the job market and is very young? Is it a retired client or a retired individual? All these things will vary the liquidity needs. For example, a retired individual will need much more liquidity than a young individual who has just entered the workforce, right? So these factors are taken into account. Then time horizon. What is the investment time horizon that is comfortable for the client? Is it an endowment or is it a retirement pension fund? So depending on the time horizon also, is it a long term, is it mid term, is it short term? Based on all these factors also, the portfolio composition can vary. Tax consideration. Is the client tax exempt? What is the taxation on capital gains vis-a-vis the income? So is the dividend being taxed more or is the short-term gain being taxed more than the long-term capital gain? These factors will also depend. Is the individual having certain kind of tax advantage? Is that individual tax exempt? All these factors are going to be taken into account. Legal and regulatory factors. What is the policy impact on the entity that we are trying to make a portfolio on? Or what is the impact of the policies on the different asset classes and the sub-level securities? So these are the factors that are going to be taken into account. Then what are the constraints of the individual or the client? What are the constraints? Liquidity constraints, time horizon constraints, other constraints. These have to be taken into account. What are the opportunities that have been created due to the regulations or the legalities? That has to be taken into account, right? Then the seventh factor is unique circumstances. Now, does the entity have ESG preferences or some religious preferences? So based on this also, portfolios may have to be changed, okay? Now, speaking about unique circumstances, we have mentioned ESG. So ESG is basically environmental, social and governance factors that are incorporated within the investment analysis process. So when we try to incorporate ESG factors, there are certain ways in which we can do it. So let's briefly discuss something about the ESG investing here. ESG integration. Now, what are the ways in which ESG is integrated within the investment analysis process? The first way is positive screening. Means, let's say one has inclination towards finding out renewable energy companies or companies which are helping the environment in some way. Let's say water treatment companies or renewable energy companies like solar energy, wind energy companies. So that is a kind of positive screening. Then negative screening. Let's say an entity has preference towards staying away from tobacco companies or staying away from inorganic fertilizer companies. That kind of screening is called negative screening. Impact investing. Impact investing, an example can be investing in startups or investing in venture capitals, which in turn invest in startups that work on different solutions towards betterment of the environment. That is one example, right? For example, let's say a company is working on organic fertilizers, or let's say a company is working on making a new kind of renewable energy lithium batteries. That kind of investment can be called impact investing, right? Then thematic investing. Like we said, a theme can be renewable energy, a theme can be companies which are, for example, renewable energy, an example we have already taken, can be a theme. And based on this theme, investments can be searched for and made into in case they are good opportunities. Now, what is the process of incorporating ESG into the investment analysis? First is identifying the scope of ESG, a relevant ESG scope. Identifying a relevant ESG scope. So what is a relevant ESG scope? For example, let's say a company is into the manufacturing of lithium batteries. Now, lithium batteries are a prime component of renewable energy cars. They're a prime component of solar energy infrastructure. So considering the changes in policies of the future or considering the environmental requirements of the future, which can in turn induce policy changes also, what is the scope of this company? what is the kind of batteries they are making, what is their advantage. These kind of seeking based on ESG premise is called identifying relevant ESG scope. The next step is derive financial materiality. So what is the market potential for this kind of an idea? What is the market potential of an improved energy density lithium battery? Let's say a lithium battery which is smaller in size and is durable for a longer period of time. That kind of battery, what is the potential for that in the markets? That is called deriving financial materiality. The third is integrating that into the valuation. So we try to integrate that factor into the valuation with our regular valuation metrics also. So we add that additional factor. Then based on this, we come across the valuation which incorporates this financial materiality of a relevant ESG scope. And after we do the valuation, we decide whether to invest in it or not. That is called taking the decision. So this is the entire process of ESG integration, and we have already discussed the different types of ways in which we can seek ESG integration, right? Now, there has to be a structured way in which we can choose the businesses or choose the investments that we require from these huge options that we have, right? Now, for that, we can segment the equity markets in different ways, and those segmentations we are going to discuss next. Now, the entire equity universe can be divided in multiple ways. One of the ways can be dividing on the basis of size. Now, on the basis of size, we can have small caps, we can have mid caps, and we can have large caps. So these are basically based on market capital of the company. Speaking from the US market point of view, if a company has a market cap of more than 10 billion, that kind of a company is called a large cap company. So 10 billion plus means it's a large cap company. If a company has a market cap between 2 billion to 10 billion, it's called a mid cap company. So 2 billion to 10 billion, it's a mid cap company in USA. And if a company has a market cap between 250 million, that is 0.25 billion to 2 billion, it's called a small cap company in USA. Now this is the way we can divide companies into sizes. Now from geography to geography, this kind of definition can change. For example, in India, the definitions will be different. Now, another way to define the markets is through style. What do you mean by style? So in terms of style, there can be primarily two extremities. One is value stocks, which means stocks which are very low in terms of price to book ratios or in terms of price to earnings ratios, but have good potential to grow in the long term. Then there are growth stocks. Growth stocks means their earnings are growing very fast, or their sales are growing very fast, or both are growing very fast. They have high return on equity, high return on capital, and they can be small or large. Mostly they are small, but many times they can be large also. And these kind of companies are called growth companies. Then comes blend. Blend means a company which is having high growth rates but having price to book ratios or price to earning ratios which are also substantially low compared to the peers. That kind of a company can be called a blend, or a blend between value or growth kind of a company, right? What is the process by which, now generally these two, size and style, these two factors are combined together to position a stock into a certain segment, right? Now how this is done? The process has a couple of steps. So the first step in the process is choosing the metrics. Choosing the metrics means what are going to be the factors based on which we are going to define the stock. Let's say we choose the factors like PE, that is the price to earning ratio, the price to book ratio, the PB, the market cap, the PEG ratio, the earnings growth rates, the return on capital, the return on equity, sales growth, etc., right? Now based on this, a scoring is done. That is the second step, right? Now, each of these factors might not be significant in the same way when we are trying to define the stock. For example, the price to earning ratio may have a higher weightage than the price to earning growth ratio, or the return on capital earned or the return on capital might have a higher weightage than the return on equity, or the earnings growth can have a higher weightage than the sales growth. Now, based on these weightages, each of the scores are weighed. So this is the third step where each of the scores are given a weight, right? This is the third step. Now, after the weights are multiplied with the scores, or the weights are added with the scores, the sum is taken out and the position is added. So the weight sum of the scores is taken out and the position is ascertained. Typically a size and style matrix looks like this. So you can see here above there is value, blend and growth, and on the column there is large cap, mid cap and small cap, and there can be combination of these things, right? Now I have written here NVDA. So this is basically the stock NVIDIA, which can be categorized as a large cap growth company because it has a huge market cap and it is growing substantially fast. Now we can do this in a simple way because NVIDIA is so popular, we know about it. We can analyze every stock in this way by judging their different financial metrics or judging their business proposition. We can take out their metrics like price to earnings, price to books, market cap, PG ratio, earnings growth, sales growth, return on capital, return on equity, and multiple other factors, give them scores, then add those scores up and create our positioning, right? This we can do for any stock. Once we have a structured format of doing this or a structured process of doing this, we can do this for any stock. Now the advantages of this kind of division. So the first advantage is it helps in portfolio construction. Are we trying to create a large cap based portfolio? Are we trying to create a small cap based portfolio? Are we trying to create a mid cap based portfolio? Are we trying to create a flexi cap based portfolio? Or are we trying to create a multi cap portfolio? Based on this, the portfolio can be designed and it is much easier once we have the portfolio structure with us. Diversification. Now, once we have segmented the entire market into different ways like value, growth, blend, large, mid, small, all these factors are taken into account and the segmentations are done, it is much easier to do a diversification of a portfolio, and whatever risks or return targets we are taking, it is much better or much more measurable when we have this kind of a division because we know how much to invest in small caps, how much to invest in a mid cap, how much to invest in large caps, whether to do a value orientation, whether to do growth orientation, whether to keep it in the blend segment. All these things we know much better once we have a structured segmentation of the entire market, right? So it helps in diversification. Then assigning benchmarks. Let's say we have created a portfolio based on large cap stocks. Now it is very easy to find out a large cap index which actually can be used as a benchmark. On the other hand, if we do not have the segmentations properly done, then we do not know which index to choose when we are trying to assign a benchmark to that portfolio. So when we are clear about the segmentation, we are also clear about which benchmark it can be assigned against or which benchmark the performance of this portfolio can be compared against. So assigning benchmark is another advantage. Then identifying the direction of change of the investments. So let's say we have invested in a company ABC and we have understood or tried to understand their prospects. Now based on that, we can also understand their value growth or value degrowth. And based on that value projection, we can actually understand which direction is it going. Is it a small cap right now, which is projected towards becoming a mid cap or a large cap in the long run? Or is it a large cap right now, which is underperforming and is expected to become a mid cap in the long run? Now these kind of projections become much easier once we have segmented the investments. Now one key disadvantage of this is the size and style of the companies changes with time. So let's say we have invested in a large cap stock and it has underperformed and become mid cap. Now the portfolio composition does not satisfy our goals. Or for example, let's say we have invested in a small cap company or a small cap portfolio. Many of those companies have become large caps. Now the small cap portfolio definition does not fit this portfolio, right? So this is one key disadvantage, that the size, style, segmentation of companies keep on changing as with time companies' performance changes. Now we have spoken about segmentation based on size and style. Next, what we'll do is we'll try to discuss segmentation based on geography and economic activities. Okay, let's start. First is segmentation by geography. Now, in terms of geography, we'll take reference of the MSCI, that is the Morgan & Stanley Capital International Inc. And this company is a renowned global investment research company that provides multiple kinds of segmentations through indices. It can be global value index, it can be global small cap index, it can be indexes based on geographies or countries or nations. So multiple kinds of indexes it produces, and which are used very widely by professionals. And in terms of geography, they divide the markets into three segments. First is the developed markets. So developed markets primarily consists of countries like USA, European countries which are well developed. Then comes emerging markets. Emerging market means they are smaller economies comparatively, but they are growing very fast, generally speaking. So these are emerging markets, example being India being one of them. Then frontier markets. Frontier markets means there is a lot of potential for growth, but they have certain bottlenecks which are preventing that growth. Now, what is the advantage of using geographic segmentation? So let's say an investor wants to diversify beyond the domestic geography, then this kind of segmentation helps. Let's say there is an MSCI index for emerging markets. Investing just based on that index can help the investor diversify beyond the geographies. Now, one of the key disadvantages of using this kind of an index provided by MSCI is the index may not be representative of where from these companies are earning, which constitute the index. For example, the Swiss index may constitute companies like Nestle, like Novartis, etc. But the issue is that these kind of companies are MNCs, multinational companies, and in fact their majority of revenues comes from international markets. So it is not the Swiss market they are drawing majority of their revenues from. So the fundamentals of these companies may depend on some other geographies than the Swiss geography, right? So this is one of the problems of using this MSCI kind of segmentation. So the solution here is, when we are trying to invest in other geographies, we have to analyze those geographies based on those parameters that we want. That is, we want, let's say, majority of the revenues to come from that particular geography itself of the investment that we are trying to make, or of the business in which we are trying to invest in. So that can be one way to do it, or one way to solve it when we are trying to invest beyond geographies. Then segmentation by economic activities. So economic activities means there are multiple industries, multiple sectors, multiple ways in which different companies are serving the global economic system. So there are energy companies, there are IT companies, there are tech product companies, there are hardware companies, there are consumer durable companies, there are consumer non-durable companies, there are software companies, hardware companies, there are textile companies, there are paper companies, there are media companies. Like this, there are multiple industries or multiple segments in which the economic activities can be divided in. Now here one key thing is, sectors and industries may mean different thing for different people. Some people may think industry to be the larger scale of things, in which sectors are the divided parts, or sectors are the segments. Some other person may think that sector is the larger circle, in which the industries are the subsets. So these both things are accepted in formatted ways. Let me discuss a couple of them. So first, there is this Global Industry Classification Standard, or the GICS. Now they start the segmentation starting from the word sectors. So they represent the entire economics, or they represent the entire economic markets constituting of different sectors, which are the largest parts. Then within them there are industry groups. Within them there are industry groups. And within those industry groups there are industries. Right? And within the industries there are sub-industries. Now that's how GICS divides the entire economic system. Then there is the Industrial Classification Benchmark, or the ICB. Now for them, the economic system consists of industries, which are the largest segments of the economic system. Then within them comes the super sectors. And within the super sectors comes the sectors. And within the sectors comes the subsectors. Now this is the way ICB divides the entire economics or entire economic system. Then comes the Thomson Reuters business classification. The Thomson Reuters business classification of the TRBC. Now for them, the largest segments of the economics is the economic sector. And within the economic sector, there are business sectors. And within the business sectors, there are the industry groups. And within the industry groups, there are the industries. So these are different ways to represent the same economic system. The GICS does it one way, the ICB does it another way, the TRBC does it one more way, right? But each of them are useful if used in the proper way, and they can also help in diversification, they can also help in portfolio construction and all those things, right? Now, index segmentation. So indices are also based on certain kinds of segmentation. Let's say the MSCI World Small Cap Value Index. What does this mean? Now this is having all the three elements. The geographic element, which is the world, here in this case, the size element, which is small cap, then the style element, which is value. So all these three things are incorporated in this index. Then the MSCI World Large Cap Growth Index. This is again having all the three elements. In terms of geography, we are mentioning the whole world. In terms of size, we are mentioning the large cap. And in terms of style, we are mentioning growth. So this is another index example. Then MSCI World Energy Index. MSCI World Energy Index. Now here, there is a different way to classify it. Now here, by world, we mean the geography. And by energy, we mean the economic activity. Then another example is Refinitiv Global Financials Index. Now here again, the global is the word which represents the geography, and the financials represents the financial services sector or the economic activity of the index, which the index constitutes of, right? So this is the way in which index segmentation is done. We may include geography, we may include geography, we may include size, we may include style, the economic activity and all that, right? Now all these investments and portfolio constructions and segmentations, these are done for the purpose of wealth creation, right? For the purpose of growth of wealth and creation of wealth. Now, there are multiple ways in which wealth can be created through investments. One way obviously is through direct investments. Once investments are done, then there are incomes of various sorts through capital growth, through dividend and all that. There is also another way of earning income, which is lending the stocks or lending the equities that one owns. So all these things we are going to discuss in the next segment.
Do you consider learning how to practically apply all these theoretical concepts to become an equity research analyst and advise clients professionally? If that is so, check out the link given in the description.
Income associated with investing in equity and creating a portfolio out of equity, right? So there are mainly two ways in which these incomes come from. One is the dividend, which is the most common thing that we all know of. And the second thing, which is much less common and much less common even among retail investors, it is mostly used by institutional investors, that is lending the stocks that are owned. Lending the stocks that are owned. So we'll discuss both the categories now. Now the first category is the regular dividend category, which most of us know of, right? When you own an equity of a company, when they share the dividends, you get that. When this company declares dividends, the legitimate owners of the stock get those dividends in a proportionate way. Then there are special dividends. Now special dividends can be because there is a lot of cash storing up in the company's reserves and there are not enough good ways to reinvest them. That can be one way. The second thing can be there has been some high amounts of profit in the recent time which the company wants to distribute to the investors, the benefits of which the company wants to distribute to the investors. That also can be a reason. These special dividends are not regular in their frequency. They come once in a while, but when they do come, they are much larger than the regular dividend amounts, right? Then optional stock dividends. Optional stock dividends is basically a dividend where the owner of the stocks gets to choose whether he or she gets the dividend in the form of a stock or in the form of a dividend. So this is an optionality, right? So these are three major ways in which dividends can be circulated or distributed amongst the equity investors. Now, dividends can be subject to income taxes. They can be subject to withholding taxes also. And the third point that one has to be concerned about is dividends tend to be infrequent, especially when the economics are going in a contraction phase or a slowdown phase. And during an expansion phase or a peak phase especially, the yield can be low. So this is an overview about the dividend income. Then we'll talk about the securities lending, the second kind that we discussed just now. So securities lending is basically a way to earn interest on loan securities. So let's say an institute owns certain amount of stocks of a specific company. Now somebody else is willing to short that stock. Now to short it, one needs to sell it without owning it. And how do you do that? You borrow stocks. And that is generally facilitated like funds such as index funds. So when they lend the stocks, they can earn interests. Now this interest can be as low as 0.5% or 1% to right up to 50% or more, right? It depends on the demand for shorting the stock which has been shorted. And one more thing is, there is cash collaterals to be given once one is trying to borrow the stocks. And the fund which has lent the stocks, they can invest this cash collateral also to earn investment income, right? The third factor, these are the two factors. The third factor is manufactured dividends. So once a borrower has successfully borrowed the stocks, those stocks in the time within the borrowing period can be declaring dividends. Now when those dividends are declared, that stock borrower has to manufacture those dividends for the lender. So the lender does not have the stocks, the borrower has them, but if dividends are declared, the borrower has to give the dividends back to the investor or the lender of the stock, right? So these are the three ways in which earnings happen when one is lending stocks. Now, a few risks that have to be taken into account. Short selling might impact the prices itself. So short selling itself puts downward pressure on the prices of the stocks that are being shorted. Now this is less detrimental or less impactful generally for the index funds, so they are more willing to do that. But for actively managed funds, this can be more impactful. The second is collateral can be subject to risks. It can be subject to market risks, it can be subject to liquidity risks, credit risks, or operational risks. Now let us discuss some more ways of earning income. Ancillary investing opportunities. First is dividend capture. What is dividend capture? Let's say a company announces X dividend dates. The investor buys it just at the right time so that that investor is taken as a legitimate owner of the stock at the time of X dividend date, right? Now once the dividends are received by the investor then sells the stock. Now generally what happens is after the dividends are paid, the stock corrects equivalently, which means the prices balance in such a way that the dividend capture should not have any additional benefits. That is, let's say the stock is $100 and dividend is $1. So after the dividends are paid, the stock would be repriced at $99. So in a net effect, there should not be any benefit of this dividend capture policy. But practically speaking, this may not happen. The stock price may not go down as much, or it may go up even, and in that case, dividend capture becomes beneficial. The second method is called covered call. So covered call is basically buying the stock and then selling or writing a call on the same stock that one owns, right? Buying the stock means you are paying out capital. Let's say the stock price is S, you are paying out S per stock, S amount per stock. So there is a negative F mentioned here, and then you are writing a call, which means you are earning the premium on it. Now why do you do that? Obviously you try to reduce the downside at the cost of limiting your upside, right? The third process is cash covered put. This is also the same strategy basically. You write the put and earn the premium, that is you do plus P, and then you deposit cash equivalent to the strike price of the put. So this is minus X, right? This is also done with a view to limiting the downside, which in turn also limits the upside. So both these policies basically reduce the downside of your investment strategy, but they limit the upside also. Right? Costs or fees associated with equity portfolio. So when an investor gives an amount to the asset manager or the wealth manager to manage that fund, then there are certain fees associated with that management, right? There are certain categories of fees which are associated with that kind of management service. And these fees are management fees, performance fees, administration fees, trading cost, marketing and sales cost, and some specific costs due to investment approach. So we'll discuss them one by one. First, we'll discuss the management fees. So management fees is basically a consistent amount that is charged on the assets under management. So let's say a company has $3 billion of assets under management. That company can charge either 0.5% or 1% or 2% of annual management fees to manage that fund, right? Now this is primarily to cover the cost of research. The amount is kept low enough that it does not significantly impact the capital invested. That is invested, right? Now, when somebody is managing the fund, when a wealth manager is managing the fund actively, the charges tend to be higher. And when it is being managed passively, let's say an index fund, in that case, the charges tend to be lower. Performance fees. Performance fees is a fees which is based on the performance of the fund. So let's say a person invested $1 billion in a particular fund, right? In the year end, it grew 50%, so it became $1.5 billion. Now, reducing the maintenance fees, you reduce the 1% or 2% or 0.5% maintenance fees from it. Let's say you have left $1.48 billion, right? So your net to net earnings or net to net capital growth is 0.48 billion. Now performance fees can be 10% or 20% of that, right? It can be 10% or 20% of that, which means it can be either 0.048 billion, 0.048 billion or 0.096 billion, whichever it is, right? 10% or 20%. Generally, this is the amount that is charged, commonly speaking. Then there is something called high water mark involved in this. Also, there is something else called hurdle involved in this. So first, let me discuss what's a hurdle. A hurdle means a minimum growth that has to be offered to claim the performance fees. That is, let's say the hurdle is 8%. In that case, if the amount or the asset growth has been only 8% net, then no performance fees can be charged. Only if it goes above 8%, then only performance fees become eligible, right? This is called a hurdle. Then let us discuss high watermark. So we have discussed the performance fees, what it means. We have discussed what is hurdle. Now let us discuss what is high watermark. So let's say the investor invested $1 billion, as we said, and that grew to $1.5 billion at the end of the first year. This is year 1, right? Now in year 2, it got reduced because of a correction to $1.25 billion. This is year 2. So there is a reduction here. And in year 3, it again went back to $1.5 billion, right? So from year 2 to year 3, there is a growth of $0.25 billion. Now high watermark says the amount has just reached the previous high. So on this $0.25 billion, no performance fees can be charged. Even though there has been growth this year, it could have been more than 8% also, but because this is just at par with the previous high or below the previous high also it can be. In any case, it cannot claim performance fees. When can it claim performance fees? If it goes beyond $1.5 billion. That is, if it goes to $1.6 billion, then only, or $1.7 billion, then only performance fees can be paid. And that also on the increased difference. Right? So let me remove the rough work here. Now, the next kind of fees that we'll discuss is the administration fees. The administration fees. Administration fees can be basically of two kinds. One is internal administration fees or internal admin fees, and the second is external function fees, fees for external function. So we'll discuss each of them one by one. What are the internal admin fees? Examples can be voting arrangements, it can be corporate actions, it can be rights issues, it can be measurement of performance related costs. Right? So attending votings, corporate actions and rights issues, they have a certain cost associated with them, and they are related to the internal administration costs. Right? What about the external function fees? So once an investor has decided to invest in a fund, there are some external functions to it which cannot be done by that fund itself. For example, it can be custody fees. Custody fees is basically some fees paid to a third party for safekeeping of the assets. For safekeeping of the assets that the investor holds. The second category can be depository fees. So depository is basically an entity that segregates the assets and keeps them and maintains the amounts of leverage, maintains the amount of cash, etc., etc. Right? So for this kind of an activity, depository fees are required. Then comes registration fees. So registration fees is basically the cost of registering an ownership or ownership claim on the assets, right? So these are the three basic or the major forms of external function fees. Now the next kind of fees is the marketing and distribution fees. So what are the different marketing and distribution fees that a wealth fund or a wealth management fund has to bear? These are employing sales and marketing after sales and service teams, running ads, cost of running ads, cost of attending or organizing seminars and conferences, costs of sponsorships, basically speaking. Then costs of creating marketing enablers like brochures, leaflets, channels, creating social media creatives, platforms, etc., etc. Then platform costs. So these are like, let's say there is one mutual fund which is trying to enlist itself in the mutual fund sahihai.com website, right? Or there is an insurance policy which wants to enlist itself in the policybazaar.com website. Now that kind of fees is platform fees or platform costs. Then comes sales commissions. So let's say when a mutual fund company does a deal through a mutual fund distributor, that mutual fund distributor becomes eligible for sales commissions, right? So this is also a cost on the fund. Trading costs. So when a fund is being run or a wealth management fund is being run, there are selling of stocks and buying of stocks, or selling of equities and buying of equities happening, and these transactions are associated with explicit and implicit costs. So this buying and selling of equities can be called trading process, and in this trading process there are both explicit costs and implicit costs. So what are the explicit costs? These are costs that can be measured separately. They are mentioned tangibly, right? So this can be brokerage costs. Let's say 0.05% is the brokerage cost. That is a tangible, separately mentioned segregatable amount that is mentioned, right? This is an explicit cost. Then taxes. Let's say tax amount is 0.01%. Then stamp duties. Ownership and registration, all these are associated with stamp duties. Let's say that is 0.01% again. Then stock exchange costs. So these are explicit costs. Then comes the implicit costs. What are implicit costs? So first cost is the bid offer spread. So let's say an investor is looking to make profit from buying an illiquid asset, right? Illiquid asset or illiquid equity. Now let's say the bid offer for that is $10 and $15. So when you are buying it, you are having to pay $15, and when you are selling it, you are having to pay $10, right? Now that investor buys it, and at the end of the year, Now it has grown. And now the bid offer is 16 and 20. 16 when you are trying to sell it, and 20 when you are trying to buy it, because it is very illiquid, right? So your growth is not 10 to 20. Your growth is not 10 to 20, although the prices have a maximum value of 10 and 20 if you see in a cross-sectional way. But the gain is not 10 to 20. It is 15 to 16. 15 to 16. So the buying happened at the beginning of the year at $15. Now the selling is going to happen at $16. So this spread itself, due to illiquidity in our example, is an implicit cost, right? Had the bid offer spread been lower, let's say it had been 10, 11 and then 16, 17, then the profits could have been much higher, right? So this is one of the ways in which implicitly costs happen. This cannot be measured separately. This is difficult to measure separately or define separately, but this does occur. Then market impact. Now let's say a certain equity has a daily transaction volume of 10,000 stocks, right? Now somebody places an order of 8,000 stocks in a single day, right? This is a buy order that somebody places. Now this is going to put a substantial amount of upward pressure in this stock price, because this is a huge order when you compare it with the daily liquidity of the stock. So this has a market impact of changing the price through the order itself. So the investor's buy order can itself increase the price, or the investor's sell order, if it is large enough, once again, it can itself reduce the price. This is called market impact. Then delay or slippage. Let's say a news has come of a quarterly result coming very good for a company, right? Let's say the news came at 10 a.m. Now one knows, as more people get to know about the results, the price will shoot up. Now, because of certain situations, the order could not be placed before 10 a.m. And by that time, let's say the stock price went up by 2%. Now this 2% is basically a cost, which is a delay cost or a slippage cost. This happened because the order placing happened at a delay from the time of understanding that there is an opportunity here. So this is called delay cost or slippage cost, right? Now we have come to the last of our kinds of costs. This is the cost due to investment approach. Now an index based fund has typically lesser cost because it is transacting less, it has to analyze less. Other than the tracking error, not much analysis is required. But on the other hand, active strategies may require much higher costs because there is active analysis, proprietary research going on sometimes, right? That entails higher costs. But index funds can be subject to one cost, which is called predatory trading. Predatory trading is a cost to index funds. Now what is predatory trading? Let's say at time 0, there is a stock XYZ which an investor realizes is going to shift from one index to the other. Let's say from the mid cap index, it is going to be shifted to the large cap index, right? And in the market in which this investor is operating, large cap indexes are monitored or bought and sold much more, right? Lot many funds are there in this large cap area. So what this investor does is, they directly buy this XYZ stock. The investor buys this XYZ stock before the shift happens. Now, this will itself put an upward pressure on the price of XYZ. And if there is a large cap index fund which later has to invest in this stock, they have to buy it at higher prices. Now, this kind of trading by this investor can be termed as predatory trading, right? This is a cost which is often the index-based funds have to pay directly, indirectly. Now the third point that we want to discuss is whether the investment approach is one of providing liquidity to the market or one of demanding liquidity from the market. Now what do we mean by providing liquidity or demanding liquidity? Let's discuss. Let's say there is a contrarian value investor. Now, this kind of an investor is always looking for underpriced stocks which are not being traded very popularly, right? Now, this kind of an investor is actually providing liquidity to the market. On the other hand, Let's say there is a momentum trader. There is a momentum trader. Now this kind of a investor or trader is actually always demanding liquidity from the market. Demanding liquidity has higher costs. Demanding liquidity has higher costs, while providing liquidity has lower cost associated, right? So these, majorly speaking, are the costs associated with equity portfolio investments. Now there is a way in which company managements can engage with the shareholders, and the shareholders can also put across their point of view towards the management. This process is called shareholder engagement. We'll discuss this in the next section. Shareholder engagement. Shareholder engagement is basically a process through which the shareholders and the management connect with each other. They connect and they communicate with each other. Information sharing happens, strategy sharing happens, opinion sharing happens in multiple ways. It can happen in informal ways like an interaction. It can happen in formal ways like voting. It can happen through con calls, AGMs, votings, etc. So a few examples of shareholder engagement processes can be cited as annual general meeting, the con calls, and the votings, right? Now, what are the points that are discussed in this kind of an engagement? One thing is, discussion is done about strategy, the long-term strategy or the trajectory in which the company is set to go, right? The second thing is allocation of capital. So in which projects or in which kind of endeavors the capital is being expended, and what are the future plans of the management or of the company as a whole. The third point is corporate governance and regulatory or political aspects. So regarding information sharing, regarding different policies in which the company has to maintain certain threshold or certain sanctities, regarding the clarity with which the management performs, regarding the network connection that the company needs to have with different aspects of the society, of politics, of economics, etc., etc. All these things come under the purview of the engagement topics. Then remuneration of the management. Remuneration of the management with respect to the long term and the short term, with respect to the performance. Is it going to be a moving average of the performance which represents a longer term perspective? Is it going to be the quarterly targets which dominate the remuneration, which represents a short term aspect of the perspective? Or is it going to be a trade-off between the short term and long term? So, and in what ratios or what proportions these trade-offs are going to be done, if at all? So this is all part of the discussion of the remuneration. Then composition of the board of directors. What are the aspects that are going to be taken care of when creating the composition of board of directors? How many independent directors? How many executive directors? How many people in the committee for how many people in the committee for CSR? How many people in the committee for audit? How many people in the committee for corporate governance, etc., etc. These things are going to be discussed here. So all these points are discussed as points of engagement. Benefits of shareholder engagement. Obviously, there are benefits both for the company and also for the shareholders, who are basically the equity holders of the company, when it comes to shareholder engagement. So from the perspective of the company, it can result in better corporate governance culture. And also, because there is an accountability communicated through these engagements, there are chances that the performance also can be better, right? There is better transparency, there is better alignment of interests both of the management and the shareholders, and there is communication, which can result in trust and commitment, and which can in turn result in better performance. Then the benefits that the shareholders can have. Obviously, performance is a benefit for the shareholders. Other than that, there is information access for the shareholders. Whenever there's an AGM, there is a con call, or there is a voting to be scheduled, there is information that is being shared, right? Then, role in setting direction and strategy. Shareholders, through voicing their opinions or participating in the voting rights, can give their opinion or help in setting the direction and strategy of the company. Then there is a third aspect, which is the free rider shareholders. So for example, a voting is happening, or a con call is happening, or an AGM is happening, more especially a voting is happening, certain shareholders, for example, certain retail shareholders, small shareholders, they do not participate generally in the voting rights or in the AGM meetings. But if something beneficial comes out of those meetings or of those voting processes, then these investors do get the benefit of it. So these shareholders become free riders of whatever activity through engagement is being done between the shareholder and the management. There are certain disadvantages of the shareholder engagement also. For example, it is time consuming and costly. Then many times it can happen that questions are asked related to the next quarterly targets, next quarter projections, next quarter profits, etc. etc. And if this focus is too much, if it is out of proportion, then it can result in short-termism. And as a result, there can be chances that the long-term results might be compromised, or the long-term strategy, brand and direction of the company can be hampered or impacted in a certain way. Then conflicts of interest. Conflicts of interest means, let's say there is a company XYZ which is listed in the stock market, and there is a fund management named ABC which has invested in this company, right? Which has invested in this company. Now ABC has both individual clients and institutional clients, and incidentally XYZ's pension fund has invested in ABC itself, right? Now ABC is the fund here, and this fund right now is in a conflict of interest. Because one of its invested assets is also its client. Now this kind of a situation can be said to be a situation of conflict of interest. For which entity? For the fund, not for the company. For the fund, it's a conflict of interest, right? Then selective disclosure. Even in the AGMs or in the votings or through strategy discussions, the management can communicate information, but it can be partial, it can be selective, it can be incomplete. So this is another disadvantage, where a complete picture is not reflected through the communications, thereby giving a misrepresentation of sorts, a chance of misrepresentation of sorts. So these are the disadvantages or the possible demerits of shareholder engagement. But at a large scale, shareholder engagement is a very important part of corporate governance culture and better performance as a whole in the long run. Now, in terms of engagement, not all kinds of firms engage in an uniform way with the company managements. For example, index-based funds have less requirement of these kind of activities because their main objective is to maintain a certain degree of tracking error or maintain alignment with a certain benchmark. They are not actively participating with the direction and strategy of companies. They are more aligned to the tracking error or the benchmark. So this is one thing that the index-based funds can afford to do a little less of, right? But this may not be the case for actively managed funds. These kind of funds may have to participate very, very actively in the strategy formation such that the shareholders are benefited in the long run, right? Obviously, non-engagement is less costly, which means engagement is more costly. So this is one of the ways in which an actively managed fund has higher costs. Then another aspect of engagement is the size of the fund. If it's a large fund, let's say even if it's an index-based fund, if it's a large fund, it can afford to spend more on shareholder engagement because the cost is distributed among multiple investors or the cost is distributed among the large assets under management. But this may not be the case if the fund is small. If the fund is small, the cost may be proportionately too high. Even for an actively management fund, if it's a larger fund, engagement becomes less costlier per unit of asset being managed, right? So fund type and engagement, this is what we had to discuss. Then there is one kind of investment which is called activist investing. Now what is this activist investing? This is basically participating in the direction and strategy formation of a company in a more involved way, right? Now that involvement can be through proxy contest, that involvement can be through higher stake taking, that involvement can be through participation in the directorship of the companies, right? That engagement can be through getting or demanding participation in the board of directors, like getting a membership in the board of directors. So there are different ways of doing it. Now, they can do multiple things. These activist investment funds can do multiple things. One of the examples of these activist funds is hedge fund. Hedge funds may often participate in activist investing. Now, what do we mean by activist investing? Let's say activist fund finds that a certain management is not going in the direction which will bring well-being to the shareholders. Now, they can do many things. For example, they can run awareness campaigns or movements on social media, on other media platforms. They can buy stocks and take up stakes. They can demand for membership in the board of directors. They can apply for proxy contests. And all this they are doing with an intention to inducing change. Right? All this they are doing to induce change. Now, one point to be discussed here is, what is a proxy contest? Proxy contest is basically these activist investment funds may do something like this. They can gather a lot of representation in the voting events, of different voting events, collecting voting opinions from a bunch of shareholders who are basically equity owners of a particular company. So they pool together a lot of votes, and this vote percentage can be significant enough to force the management or to induce the management into taking decisions in favor in which these votes have been given. So this is one proxy contest that can happen. This happens either they can directly take up the stake, either they can directly take up the stake in the company, or they can create awareness campaigns and make the awareness large enough so that the investors become aware of it and they vote in a certain way. So this is what is proxy contest. It's basically a contest between the higher management which is not aligning with the activist fund's views and obviously the activist investing fund. Right? Now, we were talking about voting. So voting has multiple roles. Why is the voting done and how can voting be done? Let's discuss that. So voting is primarily done for decision making. Let's say appointment of a new director, or retirement of a director, or appointment of an auditor, or some strategy. All these things may require voting by the voters. Proxy voting. What is proxy voting? Proxy voting is basically somebody else voting for the shareholders who are not participating in the voting event. If an investor or if a bunch of investors are not participating in the voting event, they can still cast their opinions or their votes through this proxy voting, where somebody who is representing them takes their opinions through their votes and then represents the same thing in the voting event itself, right? Proxy advisory firms. Proxy advisory firms basically give data and information and strategies and plannings and elaborate descriptions about the different events that are taking place in a company. So let's say an investor is looking to decide which direction to vote in, whether to appoint a new director or not, whether to appoint a particular management or not. In these cases, proxy advisory firms can give useful strategic or informational guidance so that that vote can be cast with highest amount of knowledge. Empty voting. There is something called empty voting also, right? What is empty voting? Empty voting is a case where somebody who is not looking to become an investor in the company itself, but they want to cast the vote, what they do is they borrow the stocks of that company and they wait till the voting event. At the voting event, they cast the vote and then they return the borrowed stocks. This kind of voting is called empty voting, where without ownership, somebody borrows the stock just to cast the voting and then returns it back once the event of voting ends. Now friends, active investing and passive investing, or active investing and index-based investing, these are not binary situations always. There can be a mix of both the aspects. Let's say somebody is tracking or somebody has the index as a benchmark, but they do take active decisions to some extent. That can also happen. Now, to what extent a fund is passive and to what extent it is active depends on multiple factors. One such factor is confidence. Confidence in the degree of the expertise of the management team or the decision-making team that they can come up with decisions which improve the performance over and above the index performance itself. That confidence is one such factor. Then, client preference. Obviously, if most of the clients want a passive investment strategy or they are of the opinion that markets are largely efficient, then active investing and raising the cost becomes needless affair, unnecessary affair. In that case, passive investing might be preferred. In other cases, clients might be preferring alpha, a large amount of alpha. In that case, higher degree of active decision making and active analysis and active investing might be required. Then it also depends on domain of investment. For example, if it's a large cap domestic equity focused fund, then active decision making might be required in a less degree. On the other hand, let's say if it's a foreign small cap fund or a foreign venture capital, then much more active decision making might be required. The fourth factor is the tracking benchmark. Now, depending on what kind of benchmark is being tracked, also decides whether the investing pattern will be active or passive. For example, if it's a benchmark which itself is very illiquid and the prices are stale, then active decision making might be required much more. On the other hand, if it's a large cap benchmark which is very liquid, then active investing might be required less. Other factors might be ESG considerations or some other constraints like religious constraints. Those things can also decide the degree of active decision making and passive decision making, right? For example, a client may prefer not to invest in tobaccos or alcohol or some other industry that they don't prefer to invest in. That can be a constraint which may require more active decision making for a fund, right? So these are the factors based on which the degree of active decision making and the degree of passive investing might vary. Costs and risks in active versus passive funds. So as we know, friends, active decision making and active processes are generally higher in cost, much higher in costs. So what are the costs and risks of active funds vis-a-vis the passive funds? The first is taxes. Now, active funds may end up paying more taxes. One is due to higher turnover, and second, they might not have certain kind of provisions which certain index funds may have, right? So active funds may end up paying higher taxes. Turnover. In terms of turnover also, active funds have higher numbers, which means they have higher turnover related costs, which means trade transaction costs, stamp duty cost, registration cost, etc. etc. Key person risk. Again, in case of an actively managed fund, the key person risk is higher, right? Because that key person might be the decision maker, or that key team might be the decision making team for the fund. Performance. In terms of performance also, actively managed funds tend to have higher risk because they have higher chances of not performing despite the higher costs. So these are the costs and risks in active funds vis-a-vis the passive funds. What are the advantages of index-based strategies? Now, highly evolved markets also are much more efficient markets. The efficiency of the markets are also high, which means the fundamental conditions of the underlying factors of the macroeconomics and the microeconomics both are reflected much more in the prices themselves. So in this kind of a scenario, index-based strategies which have much lower costs have an upper hand, have an advantage. Then obviously, because index-based strategies are passive strategies, they have lower costs because they have less active research, less transaction cost, etc., and also they are managed by smaller teams. So which means they have lower costs. So these two are the primary advantages of index-based strategies. Now we'll discuss about benchmark selection when creating a fund or a portfolio. So typically a fund is looking to create a benchmark out of an index, existing index, right? Or it might also try to create its own index for its own portfolios, which might be a much more complicated task. Generally, we'll consider the factor where they are looking for an existing index. Now, in that case, for investability in an index, that index must be rules-based. That is number one criteria. Number two is it must be transparent. That is, the fund managers or the investors should know how these constitutions are being done. Now, one needs to know what are the criteria based on which these 50 stocks have been filtered into the index. That rule has to be transparent. Then it also needs to be investable. Now, investable means, let me take an example here, the value line geometric index. Now, this is a geometric root of the constituent stocks. For example, it might have n number of stocks and the prices of each of those stocks can be P1, P2, P3, till Pn. Each of those prices can be P1, P2, P3, P4 till Pn, right? Now, how this index is measured is the prices are all multiplied with each other. P1 into P2 into P3 into P4 till Pn. These numbers are multiplied. Then a root is taken, nth root is taken. So this is the nth root of the product of all the prices of the constituent stocks in the value line geometric index. Now, investing in this kind of an index is not possible. This is a non-investable index. So it has to be, for investability, an index needs to be investable. The rules might be transparent. It might be rules based, but it needs to be transparent, right? So transparency is a very important aspect when one is choosing an index. And what about the rules? We just spoke about the transparency of the rules. What should be the characteristic of the index rules? The characteristics of the index rules are mentioned here. They have to be objective, they have to be consistent, and they have to be predictable. Objective means there is no judgment involved in it. There is minimum amount of judgment involved in it. Consistent means those rules should be consistent. They should be applicable throughout cross sections and throughout time, right? Throughout multiple stocks, throughout the entire range of stocks, and across times also. Predictable. Predictable means by analyzing the index, we might be able to understand that which stock is going to be constituted in the future and which stock might not be part of the future, which is currently right now a part of the index. So this is predictability of the index. So objective, consistent, and predictable. Now, when an index is being formed and the constituents are being decided, there are chances that in the future, some of those constituent stocks might have to be moved out of that index. And similarly, some other stocks might have to be included in that index. So this is the index, let's say. And they have, let's say, 50 stocks right now. Now, some of those stocks will move out with time because of their performance. Maybe it's a small cap index, and because some company grows, it may move to large cap index. This may happen, or this may also happen. Also, it may so happen that, let's say, this is a large cap index. This is a large cap index, and some mid cap stock, which was so far called a mid cap stock, it performs better, and it has to be made an entry into this large cap index. So stocks have to be reconstituted. So stocks might have to leave the index, stocks might have to enter the index. Now this can cause instability of the index. Now, to create stability, two processes are used, buffering and packaging, which basically provide stability while adding and removing stocks from an index. So we are trying to create a position of stability here, right? So buffering and packaging, how do they add stability to the index? Let's understand. Let's say we have an index, MSCI Large Cap USA. This constitutes the top 300 large cap stocks of the US stock markets, right? Now there is a mid cap stock. There is a mid cap stocks which is performing well enough that it can be constituted in this index, right? Now it is not done in a random way. How it is done? Let's see. Now let's say the criteria is it has to become the top 300 stocks. Now MSCI Large Cap USA top 300 means it has the top 300 stocks based on its own criteria. Now for making an entry, the mid cap stock should require just to reach the rank 300, right? But because of buffering, this rule changes. The rule says that no, 300 is not the rank that can qualify this mid cap. The mid cap has to reach the rank of 200. It has to reach the rank of 200 based on the MSCI Large Cap USA rules to make it into the index. And if a stock has to be moved out, because of underperformance, it just needs to be 301 usually speaking. But because of buffering, this rule is changed. The rule says that no, not 301, the stock has to become a rank of 451 to be moved out of the index. So this way, some amount of stability or delay is added into the movement of constituents of the index, which adds stability to the index. Now, what about packaging? There is an index which is called the CRSP index, the Center for Research on Security Prices Index, right? CRSP index. Now, here for adding stability, something called packaging is used. How this works? Let's see. Let's say there is a mid-cap stock which qualifies to enter into the index. This is a large cap index, let's say. Okay. So this mid-cap stock qualifies to enter into the CRSP index. Now immediately the entire stock should enter into the index, right? 100% of the stock should enter into the index. But this is not how it is done. Only a portion of the stock is allowed to enter in the first iteration. So only a part of the stock makes an entry into the index first. Then the waiting is till the next reconstitution date. So after the first part 1 is done, then the wait is till the next reconstitution date. And in this next reconstitution date, the remaining or another part of it will be entered. Part 2 or the remaining part. And this is how stability is added through packaging in the CRSP index. So buffering means there is a buffer in the rank, and packaging means the entry is made but in parts, in installments.
A point for you to consider. Learning artificial intelligence and coding can give you an edge in the career of finance, and it is not difficult to do so. Being in the profession of finance and into AI engineering, I can assist you in the same. If you find this interesting, check out the link given in the description.
Considerations when choosing a benchmark. So the three main criterion which decide which benchmark to be chosen are geography, style, and size. For example, somebody is looking to buy large cap stocks in India, large cap value stocks in India. So the reference index could be India Large Cap Value Index. Or let's say somebody is looking to buy US large cap value stocks. The reference index could be USA Large Cap Value Index, right? Apart from that, one more criteria that could be added here is economic activity. For example, somebody is looking to invest in the renewable energy sector of USA or renewable energy sector of India. For that investor or for that fund which is focusing in this segment, some renewable energy index might be useful, right? That can be available by some index provider, or that may have to be constructed, whichever way it is. So considerations when choosing a benchmark: geography, style, size, and one more criteria which is economic activity. Apart from that, in recent times, one more criteria has become very, very useful, which is ESG criteria, right? Environment, social and governance criteria. This is also a very, very important factor, because environmentally, socially activities are tending to become, or they are intended to become, more inclusive with time. Therefore, ESG becomes more and more important, right? So these are the factors: geography, style, size, economic activity, ESG. Index construction methods. So friends, index can be created based on multiple rules. It can be based on the market cap. It can be based on free float. It can be based on stock price. It can be based on equal weights of all stocks. It can be based on fundamental factors like price to book, earnings growth, sales growth, return on equity, and all those criteria. So these are the different ways in which indexes can be constructed, and we will discuss each of them a little bit. So the first thing that we'll discuss is market cap weight index. So what is the process of creating a market cap weight index? Let's say we are trying to create a large cap index. Large cap index in USA means $10 billion plus in market cap. Now, the first thing we do is calculate the market cap of stocks, right? Calculate the market cap of stocks. Filter the stocks out which are fulfilling this criteria, right? Now, let's say there are 50 stocks fulfilling this criteria. 50 stocks fulfilling this criteria. Now, the next thing we do is add the market caps, sum all the market caps of all these 50 stocks. Okay, let's say this filter qualifies 700 stocks. 700 US stocks have a market cap of more than $10 billion. The next step is sum those market caps. Add all those market caps up. So the total value calculated is V is equal to sum of all the market caps of all the 700 stocks, right? Next step is give weightages. Give weightages. So what is the weight of a single stock in the index? This will be decided by this weightage. How it will be done? Let's say out of this 700 stocks, one company's name is XYZ. So weight of XYZ, WXYZ will be measured like this. This will be equal to market cap of XYZ divided by the added value of all the market caps, sum of all the market caps. This will be the weightage for a particular stock, and in every case, and for every stock, this will be the calculation. Now, once the weightages are there, based on this weightages, the index is created. Let's say the initial value of the index decided is 1000, right? And a stock has 10% weightage. So that stock will have a value of 100 in this index. Another stock, let's say, has 1% weightage. That stock will have a value of 10 in this index. Another stock, let's say, has a weightage of 5% in this index. That stock will have a value of 50 in this index. And as the market caps keep on changing, these weightages will keep on changing, right? Now, we will discuss the advantages and some disadvantages of a market cap weight index. The advantages first. Market cap weight index reflects the market sentiments. So which stocks are trending, which stocks are in momentum, they tend to be at the top of the ladder in any case, right? And therefore, a market cap weight index always reflects the market sentiments, right? How people are viewing the markets, that is reflected by these kind of indexes. Lower turnover. Because weighing through market caps generally leads to stable companies being filtered out to be chosen in the index, that means the turnover becomes lower. Large cap stability. This is again an offshoot of the lower turnover aspect only. Specifically, if the index is a large cap index, they tend to be very, very stable because such large companies take time to form, and once they form, they have a very, very stable and matured business. Even if it is a high growth business, they still are very stable in their position of being a large cap, right? Reflects a strategy's investment capacity. So let's say all the small cap companies put together in a market give a value of $100 billion, right? They give a value of $100 billion. Now, a fund has an AUM or assets under management of $50 billion, right? It's a huge fund which has an AUM of $50 billion. Now, it will be very difficult for this fund to invest in this kind of a segment where the entire total market cap is only $100 billion. Now, if their strategy is just small cap index, the investability is reduced. But if they shift it to diversified or large cap and mid cap, then their investability increases. And in this aspect also, choosing the market cap weight index basically gives an idea of how investable the strategy is going to be. Mean variance efficient. So mean variance efficient means for a particular level of variance, the return is highest in case of a market cap weight index compared to all other styles of weighing or creating the index. For any particular level of variance, this kind of index gives the highest return, right? Now, not only advantages, there are some disadvantages associated with this also. Market cap weight index have a market cap size bias, which means large caps tend to get much more significance in a market cap weight index. Then there is momentum bias also, because it largely reflects the market sentiment. Certain cases might be there when the fundamentals diverge from the sentiments, and in that situation, this kind of a momentum bias can be a matter to be aware about. A huge portion of the entire market cap of a stock market is constituted solely by the large caps. In terms of market cap, in many cases, a very small number of companies, maybe 10 or 20 companies only, they may constitute more than 80% of an index. More than 80% of an index. In that case, investing based on a market cap index can create high amount of concentration, right? Now the next kind of index that we'll discuss about is free float adjusted market cap weight index. What do we mean by free float adjustment? Let's discuss that. So let's say there is a stock XYZ. Company XYZ is a listed company. Now there are two segments in this. There is one portion of shareholders who are the management or the owners. And there are the other shareholders. Now this can constitute the institutional shareholders, minority shareholders, etc., etc., right? Now whatever trading is being represented by an index is mainly this other segment. This other publicly available segment is being traded on a day-to-day basis. And this management and owner part changes much more stably, right? It does not change that much, or it does not change hands or get traded that much. It is very fixed or stable. In the very short term, it is generally not available to the public. So therefore, this other portion is the free float. Let's say a company has a market cap of 100 billion and the free float portion is 40 billion. So this 40 billion is a better representation of the market than the entire 100 billion in terms of frequency of trading or in terms of fluidity, liquidity, etc., etc. So there is a need for free float adjustment if one is considering this. And this adjustment to the market cap weight index adds some advantages to the index calculation. So these advantages can be: represents shares available to the public. Obviously, the index is made up of common shares which is available to the public, and it represents the daily market activity much more than including the entire owner portion also, right? The second is accounts for limitations on foreign ownership of a company also, right? Many countries have limitations on foreign ownership of equity. That is also represented here. Those regulations are also accounted for here in the free float adjustment. Now the disadvantages, one thing is it is complex to calculate. It is complex to calculate. It has to be a number of things need to be included, like treasury shares, like share repurchases, like ownership dilutions, like FPOs, right? All these things have to be taken into account. IPOs if it's an initial stock offering. So all these things have to be taken into account, and many times it requires judgment. So this is the second demerit, may be dependent on index provider's judgment. Some judgment might be used to handle this kind of ambiguity or complexity, because how many FPOs have happened, what is the condition of the treasury shares, what is the degree of change in the ownership of the company. All these things have to be taken into account when making these adjustments. So this is one more disadvantage, that judgment might be required. First of all, it is very complex to calculate. Now friends, till now we have discussed market cap weight index and free float adjusted index, right? The third kind of index that we'll discuss is price weight index. Now how does one create a price weight index? So first what happens is one selects equal number of shares of n stocks if the index is supposed to constitute these n stocks, right? Equal number of shares are taken into account, then their prices are added, to deduce the index value, right? So n stocks, let's say P1 is the price of stock 1 plus P2 is the price of stock 2 ... till Pn is the price of stock n. All these values are added to get the total price, and weightages of each of these stocks are basically decided by weightage of any stock I is equal to price of I divided by sum of P, right? And this is how the index weightages are also given. Let's say if the index value is starting at 1000, then proportion of stock I in this will be equal to weightage of I multiplied by 1000. If the weightage is 10% for stock I, then the value of stock I in this index will be 100. Right? This is how it is decided. Now, a few features. One feature is highest price stocks have the highest weight. So, if a stock has a price of $10,000 and a stock has a price of $100, obviously the one with $10,000 will have 100 times more weightage. This is one of the features. Now, this can be a demerit also because the price does not necessarily define the market cap. The market cap can be different, the fundamental valuation can be different, and the price is not representative of the value of market value of the firm or the intrinsic value of the firm. So this can be a disadvantage, right? Advantages, it is easier to understand. The second feature is stock splits reduces the weight of the stock, right? Because let's say a stock was priced at $100, then a stock split happened, 2:1 split happened, and it became $50. Obviously in the index, the weightage will be reduced by half, right? This is another feature. Now a few advantages are also there. It is simpler to understand. Lesser need to rebalance. Obviously there is auto rebalancing happening. Actually I should write there is auto rebalancing happening. So no need to rebalance because auto rebalancing is happening. As the prices change, the weightages are automatically changing. So no need to rebalance. Then long historical data available. Obviously, as long as the stock has been enlisted, the prices will be available, and as long as the index has existed, the prices of or the values of the index will be available. So long historical data might be available. Disadvantages, investments generally do not work this way. Obviously, investments generally try to find out the fundamental value, that is the present value, or at least the market value, right? These two things are important. What is the price per stock finds lesser importance than these two values, or the enterprise value is also very important. And the price may not be a proper representation for any of them, right? Next we move on to equally weighted index. So how is an equally weighted index formed? First is select the constituents. Let's say there are n constituents: stock 1, stock B, stock 2, stock 3 till stock n. There are n constituents. We take equal weights of this. So let's say if there are n stocks, weight will be 1 by n. If there are n stocks, weight of any of the stocks will be equal to 1 by n. Right? So all of them are equally weighted. Then calculate the initial value. So let's say we decide that the index starting value will be 10,000 and there are 100 stocks. N is equal to 100. So weightage for each of these stocks will be 1 by 100 or 1%. And the value or the proportion of the stock in this index will be represented equally, which means stock 1 will have a value out of this 10,000. Stock 1 will have a value of 100. Stock 2 also will have a value of 100. Stock 3 also will have a value of 100 till all the n stocks. All of them will have a value of 100. Right? The fourth step is update and rebalance. So select the constituents, give equal weights, calculate the initial value, and update and rebalance. This is a very important factor because in equally weighted index, the value changes instantly as tradings keep on happening. So rebalancing has to be done very, very frequently. Now there are very significant advantages of this. The first advantage being it has very high degree of diversification. Because even a small cap or a mid cap gets equal representation in the index compared to the large cap, right? Return superiority, especially in expanding markets, this kind of index might well exhibit return superiority. Higher representation of small caps, as we said that small caps in this kind of an index are represented much better. Now this brings us to the disadvantages also. Greater exposure to lesser liquid stocks. Small caps by definition generally are less liquid, which means one invested in this kind of an index is also invested in stocks which are less liquid, right? Higher volatility. inclusion of smaller stocks obviously results in higher volatility in general speaking. Frequent rebalancing. Obvious, again, as the market value of the stocks change, the weights change. As market trading happens, the weights of the stocks change, so they have to be rebalanced frequently. The next form of index that we'll discuss is the fundamentally weighed index. Now, what are the steps to create a fundamentally weighed index? The first step is choose the key fundamentals. What are the fundamental metrics that you want? Firstly, let's say we want PE ratio. Then let's say we want PB ratio. Then let's say we want return on equity. Also, let's say we want earnings growth. We want sales growth. We want debt to equity ratio. All these metrics, let's say there are n number of metrics that we take into account. Now, after we have taken into account what are the metrics that we want, we give them scores. For a particular company that we select, we give them scores for each of the metrics, right? This is the second step. We scored the price to earnings, we scored the debt to equity ratio, we scored the return on equity, and like this we give each of them scores. And then the next step is aggregation. Now we have all these scores, right? Let's say there are n metrics and the scores are, let's say, x1, x2, x3, xn. These are the scores. Now to each of these scores, weights are added. So there is a weight added to P ratio. Weight 1, x1, let's say. Let's say x1 is the score of P ratio. So there is a weight added to this score. So this is weight 1, W1, which is the weight, into x1, plus W2 into x2, plus W3 into x3. Like this, there are n factors or n metrics with which n weightages are associated, right? And all of these numbers are summed up. This process is called the process of aggregation, right? Once the aggregation happens, the index is formed. And then the only thing left to be done is rebalancing. As the P ratio changes, as the earnings growth rate changes, as the return on equity changes, a particular frequency is chosen in which the rebalancing is done. Now this is the way of creating fundamentally weighed matrix. So fundamentally weighed matrix. Now what are the advantages and disadvantages of this? Advantages, first is potential for outperformance, because here we are not relying on momentum or market sentiment, we are relying on fundamental metrics. So there is potential for outperformance. Then reduction of overvaluation risk. Reduction of overvaluation risk, which means there is less risk of buying an overvalued stock just because of sentiments. Diversified exposure. Now, irrespective of the market cap weighted indexes, what stocks they are constituting, some stock which may not be included in the index might have great fundamentals, and there is an opportunity to invest in that kind of a stock is if one is following a fundamentally weighted index instead of a equally weighted index or a market cap weighted index or a price weighted index, right? Some disadvantages are also there. Higher turnover and costs. Obviously the matrix that have been chosen keep on changing and one has to rebalance and reconstitute based on that, which means there is higher turnover and which implies there will be higher costs. Complexity and data dependency. There is huge amount of complexity in constructing this kind of a matrix because one has to decide the matrix to be chosen. One has to decide what are the weightages to be given to each of those metrics, which means there is high amount of complexity and data dependency, and the data also needs to be of high quality. Then may underweigh growth stocks. Now if the fundamental value orientation is there, chances are a stock with a high PE might be scored low, which means some other factor like its growth potential might be ignored. Obviously here we have taken into account the earnings growth rate, But let's say if somebody chooses to give less weightage to it, then chances are a growth stock might get ignored or underweight in this kind of an investment policy, right? So this is all about the types of index construction that we have to discuss. Now we'll discuss a little bit about rebalancing and reconstitution also. We have spoken about reconstitution, how through buffering and packeting reconstitution can be done, like adding stocks or removing constituents, right? This has already been discussed a little bit. Rebalancing is basically changing of the weights of the existing constituents. Now, these things can be predicted prior. Specifically, the reconstitution part can be predicted priorly, which may lead to predatory trading. That means, let's say a stock A is there, which is going to be shifted from a mid cap to a large cap. Now, a predatory trader can buy this beforehand. And this kind of buying can push up the prices even before it reaches the large cap stocks. And once it reaches the large cap index, what happens is the index funds which are tracking this large cap index may have to pay a higher price to buy the stocks of A. So this kind of a trading scenario is called predatory trading. This can be prevented by creating a voting committee for reconstitution. Means there will be a committee that will decide what are the stocks to be added or removed from a index. This makes it harder for predictions to happen prior. Now let's say an index is completely rules based. Its rules are objective and quantitative. In that kind of a scenario, all the stocks which clear the filters get selected. Now this kind of a stock will have lesser turnover. But let's say first the rules-based filtration is done. Let's say first 100 stocks are chosen. Then out of this further filtration is done. Based on much more deeper research. Maybe qualitative research, maybe fundamental research, etc. Maybe technical research, right? Quant research, etc. Now based on this, if stock selection is further being done and let's say another 50 stocks are removed and only 50 stocks are selected, then this kind of a scenario may lead to higher turnovers, right? Stock selection based indexes may have higher turnovers than exhaustive inclusion of rules based indexes, right? Because that is an extra layer of filter which may be much more fluid and the criteria may change much faster. Now friends, during the large cap index discussion, we spoke about something called concentration risk, right? Concentration risk. Now this degree of concentration can be measured from this Herfindahl-Hirschman index, HHI. This is basically the squares of the weights of all the constituents in an index. Let's say an index has n constituents and the weights are from W1, W2, W3 ... till Wn. Weights of each of these n stocks is W1, W2, W3 till Wn. Now HHI is basically sum of all these weights squared. Now the minimum number or the minimum value for this can be 1 by n. This is the case when the index is equally weighted. Now how is the minimum value 1 by n? Let's calculate this. Let me remove the rough work here. So if an index is equally weighed, each of the stocks have a weight of 1 by n, and if you square each of these weights, this becomes 1 by n square. And if you add all the weights of n stocks, 1 by n square plus ... till plus 1 by n square for n stocks, this becomes equal to n by n square. So this is equal to, if n and n get cancelled, this becomes equal to 1 by n. That is why in case of an equally weighed index, the HHI or the Herfindahl-Hirschman index is equal to 1 by n. This is for equally weighed. And the maximum value can be 1. So here what we can do is we can give the range from 1 by n till just less than 1. So when is it very close to 1? When let's say one stock has a weightage of 99% and 10 other stocks or 100 other stocks are there which together have a weightage of 1%. In this kind of a scenario, the value will be almost 1, right? Obviously, this is an extreme scenario. Things generally don't go that way. But theoretically speaking, it can tend towards 1, right? Now, a derivative of this HHI is the effective number of stocks. Effective number of stocks is equal to 1 by HHI. So let me remove the rough work once again, just to elaborate this. Let's say there are 3 stocks in an index. One has a weight of 50%, one has a weight of 30%, and one has a weight of 20%. So the HHI in this case will be equal to 1 by 2 square plus 3 by 10 square plus 1 by 5 square, right? This is equal to, let's calculate it. This is equal to 0.38. 0.38. Now, what is the effective number of stocks? Effective number of stocks is 1 by HHI. So 1 by 0.38 is equal to 2.63. So although actually numerically speaking there are 3 stocks, 50%, 30% and 20%, there are 3 stocks, effective number of stocks is less than 3 because one of the stocks has 50% weightage, one has 30% weightage and the other has 20% weightage. Now what would have been the case if there would have been 4 stocks with 25% weightage each? So there are 4 stocks with weightage of 25% each, 25, 25, 25 and 25, right? So HHI is equal to 4 into 0.25 square, right? This is equal to what, friends? Let's calculate. 0.25 square into 4. This is equal to 0.25. And the effective number of stocks would have been equal to 1 by HHI, which is 1 by 0.25. This is equal to 4. So in case of equally weighed index, the effective number of stocks is exactly equal to the actual number of stocks. As the weightages vary, the effective number of stocks goes away from the actual number of stocks. So friends, that's about it for this chapter. Hope you enjoyed the video. If you have any doubts, please share in the comments. Till then, see you in the next class.
Thank you so much, friends, for being with me in this class. If you found this class valuable, please like the video and subscribe to the channel. Share your feedback in the comment section below and share this class with a friend who may find this helpful. And once again, if you want support regarding your CFA exams, if you want to know how to practically apply these concepts, and if you want to learn artificial intelligence and its application in finance, please check out the link below. See you in the next class. Thank you so much.